Hello. I'm going to talk with you a little bit today about business decisions and some of the numbers behind the ways or reasons that companies make certain business decisions. So we're going to pull up the screen here, pull up the sheet here. Okay, so business decisions. Um, what we're going to look at now is four different types of business decisions. And these are pretty common business decisions that a lot of businesses make. But even if you I guess what I would say too is even if you're not looking at these precise business decisions, there are aspects of these business decisions and parts of the decision-making process that I think can be helpful with other business decisions, as you'll find. So what we're going to do is we're going to look at the numbers. What are the numbers behind business decisions, certain types of business decisions? But we're also going to talk a little bit about the qualitative aspects. And just because something makes sense from a number standpoint doesn't mean it's necessarily in the best interest for a company to do it. So the qualitative factors or the non-numbers factors do make a difference in a lot of decisions. And so we're going to look a little bit at both of those in regards to some of the decisions we're going to look at here in just a moment. Going to start with a couple of terms. One is going to be incremental costs and incremental revenues. What these are, incremental cost and revenues, are the cost and revenues that are specifically related to a particular objective or a particular alternative. One thing when you're making a business decision is you really want to view what is specific to a particular division, to what is what is what cost or revenues are particular to a certain decision or a certain alternative. That's what you're looking at. What's different if I choose A versus I choose B? Or what's different if I choose B than what happens if I choose A? And so you're looking at incremental cost or revenue. These basically are cost or revenues that matter and make a difference as far as a particular business decision. Now, another term is sunk cost. And what sunk cost is sunk cost is like a past amount that's been spent, and it really shouldn't factor into future decisions. Sunk cost would be like if you spent money on research and development for a new product, but just before you were about to release this product or start production, one of your competitors came out with something that basically made it, excuse me, made your new product irrelevant. Then you really should only look to the future. You should not look back at what you spent in the past because it can't be changed. And so sunk costs should not factor into future decisions. Now, opportunity costs are the cost of the other alternative. Think of it this way. If I choose A, it's what I've given up by not choosing B. If I choose B, it's what I've given up by not choosing A. And so opportunity costs definitely factor into future decisions. And you should want to make decisions that give you the lowest opportunity cost or decisions that give you the greatest overall benefit. Okay, so the first of the type decisions that we're going to look at are make or buy decisions. And make or buy decisions, there is a decision rule kind of for each of these decisions we're going to look at. There's a decision rule. And that is if incremental cost to make is less than buying, make the product. Select the action with the lowest cost. So when we're talking about make or buy decisions, what we're talking about is, should we make it ourselves or should we buy it from the outside? In essence, it's an outsourcing decision. Should we outsource the product from someone else or should we do it ourselves? And so the rule is you want to select the option with the lowest price. So if it's a lower price to make it yourself, you make it yourself. If it's a lower price to outsource to another company, you outsource to another company. Now that's kind of the financial rules of it. Now that's the quantitative. Now the qualitative, I think the biggest aspect of this from a qualitative purpose would be if we outsource a product to someone else, we give up control. We give up control of the quality. We give up control of the timeliness of delivery. And so we've really got to trust a supplier a lot to turn over control over something of that nature. Because think about it, if they're late or if they basically give us a a shipment that's doesn't meet our quality standards, then we might have to shut down production if it's like a part maybe or something. So so basically that is a big qualitative aspect of the decision when it comes to make or buy decisions. So let's look at some numbers. So let's say that a company pays can pay $7 per unit to have someone make a part for them on the outside. They can make it themselves for direct materials of $3 a unit, direct labor of $2 a unit, incremental overhead of $1 a unit. So we would look at a cost analysis of here. So the cost to make would be $3 of direct materials, $2 of direct labor, and $1 of incremental overhead. The cost to buy would be $7. So in this case, it only costs $6 to make, $7 to buy. The company would be better to keep making the product. And again, the decision alternative is you want to make the choice, or you want to choose the option with the lowest cost to the company. Now, one thing I did want to mention about this, and that is when it comes to overhead, you don't imply the total overhead. You only want to imply incremental overhead. Incremental overhead would be what changes. If we decide to buy, what changes with overhead? And so that would be the incremental portion. Because if we decide to buy this product and not make it ourselves, there's going to be some overhead costs that are going to stay. You know, that part of the plant, the equipment, there's just going to be some costs that don't go anywhere. And so we are only really concerned with the incremental overhead, which would be really what costs go away if we decide to buy. Now, one thing that you'll kind of see is that if you decide to buy, typically what costs go away are your variable costs. Notice direct materials, direct labor. And a lot of times, even that would be almost considered your variable overhead that would go away as well. Okay, so let's look at one more. Let's look at one more question here. So if we can produce a product, if we can purchase a product for $250 per part, let's say a part. So we can purchase it for $250. The direct materials, if we decide to make it, would be $120 per part. Direct labor, $1 per part. The incremental overhead, 80% of direct labor, but the predetermined overhead is 200% of direct labor rate. So what would the numbers look like based on this information? Basically, if we decide to buy, that's going to be $250 per unit purchase price. And then if we decide to make, direct materials of 120, direct labor of 1, and incremental overhead of 80. And again, the incremental overhead is always what we look at with these decisions, because that would be the overhead that would change if we decided to buy. We don't use the predetermined rate because this is more of your total overhead. And we know that if we decide to buy, there's typically going to be some overhead costs that stay. So that's why there's a difference between the predetermined and the incremental, and we always want to go with the incremental. So in this case, basically, the cost to make is $3, the cost to buy is $250, so the company should buy the part. Now, again, this is a quantitative analysis. So this portion of it is looking at quantitative analysis. This is looking at what do the numbers tell us. But again, companies always want to examine the qualitative aspects of a decision as well. Because just because something makes sense money-wise doesn't mean that it's not in the best interest of the company to not do that decision or to make that decision. So again, the qualitative aspects also factor in with the quantitative aspects, which is what do the numbers tell you. Okay, so that's one type of decision. Another type of decision is going to be sell or process further. And the decision and sell or process further, what this is a situation where a company can produce a product to a certain point and they can sell it as is, or they can take more time and money to process it further and sell it at a higher price. Which alternative is better for the company? Now, the decision rule is choose the alternative with the highest income. So the decision rule would be if we make more money by selling as is, sell it as is. If we make more money by processing further, process further. So let's look at some examples here. Let's say one, what if a company can sell their product for $67.5 as is, and or spend 312,500 and sell for 468,750. You can kind of set it up kind of like this. Revenues, if we sell as is, we make 67.5. If we process further, we'll make 468,750. Our additional cost would be 0 if we sell as is, 312.5 if we process further. So our income would be 156,250 if we process further, and 67.5 if we sell as is. So in this case, the company should process further because they're going to make an additional 88,750 to process further. Now, a couple of things I want to say about problems like this. One is that there's typically a cost to basically to get the product to the condition to sell as is. So like in this example here, let me add in a line. Let's say that they can sell as is for 67.5. Let's say it cost them to initially build the product or to manufacture the product, let's say are $50,000. So they spend 50,000, they can sell it as is for 67.5, or they can spend another 312.5 and sell for 468,750. Now, one thing, whatever was spent to initially develop the product, to take it to the point where you can sell as is, or you can develop it further, spend more money, develop it further, and sell it at a higher price. This is not part of the equation. And the reason being, I want to say, is because this is more of a sunk cost. This is money that's already been spent, and it really does not matter into the equation because this would be a part of your cost, whether you sell as is or whether you process further. It's not really an incremental cost or revenue for either point. It's not really an incremental cost of either point, of either side, selling as is or process further. And it really doesn't factor into the decision. It's more like a sunk cost. It's already been spent. There's nothing we can do about it. And it really does not factor into the decision. What factors into the decision is, do you make more by selling as is, or do you make more by processing further? Now, let's look at one more example. Let's say that a company has 200 partially completed jobs or products. They can sell as is for 60, or let's put in a line here. Put another line here. Let's say the cost to initially develop was 50,000. They can sell as is for 60, or they can spend an additional 12.5 and sell it for 80. So what is their best option to do? Sell as is or process further? So in this case, if they sell as is, they'll sell it for 60,000. If they process further, they'll sell it for 80. They have no additional cost if they sell as is, 12,000 if they process further. So in this case, basically they will make 68,000 if they process further, 60,000 if they sell as is. So they should process further because they will make an additional $8,000, the 68 minus the 8 if they do. Now, one other thing I wanted to mention about this, again, remember that the cost to initially develop, to take it to the point where you can sell as is or process further, does not factor into the decision. So notice I've not included that in the decision here. And also here, think about this. Here's kind of another way to think about it. From a qualitative standpoint, sometimes for the company, the decision might be made on something other than just this information here. What if a company needs cash very quickly? They might be forced to sell as is in order to get the cash much quicker because it's going to take more time to process further and more time to sell the product and get cash flows coming in. So based on the nature of a business, sometimes a company might be forced to sell as is. And they do need to revisit this often because sometimes market factors might change. And if there is kind of as supply and demand goes, if there's more demand for sell as is, they might be better off to sell as is versus processing further. And so sometimes the demand might change for those as well. I mean, if everybody's processing it further, there might be less supply of sell as is. So there might be more of a market for selling as is. So again, it's something that they kind of want to look at regularly when making business decisions. And sometimes it comes down to the needs of the company or the needs of the marketplace, as I just discussed. Okay, now our third decision we're going to look at is segment elimination. And what this comes down to is, should you eliminate a segment or keep it open? And what it kind of boils down to is sometimes a segment or a division or a part of your company will appear to be losing money, to having a loss, a net loss, basically. And should you close it or not? And what you want to look at is, are we more profitable as a company on the whole, keeping it or eliminating it? And there's going to be times, as you're going to see, when it's better off, even if a segment of your company is experiencing a net loss, you're better off to keep it. And so this is something that's going to come up sometimes in business. So a couple of terms here: avoidable cost and unavoidable cost. Avoidable costs are costs that if you eliminate a segment, they are eliminated, they go away. Unavoidable costs are costs that if you eliminate a segment, they don't go away, they stay. Avoidable costs tend to be more of your variable cost. Variable costs tend to be based on activity, and if activity goes away, the costs go away. Unavoidable costs tend to be more of your fixed cost, because they are certain costs that are going to remain whether you basically do away with the segment or not. And so one thing to think about here too is that some costs from headquarters are allocated out. Most companies will allocate the cost of headquarters, like accounting, information technology, HR. They'll allocate that cost out from headquarters. And so this cost basically will be allocated out to all the units. So if you close this unit, that cost will just be allocated amongst the other units. So in some cases, if a company is losing money because of costs that are allocated to it from headquarters, you'll just make yourself worse off if you close it, because then those costs will just go out to all the other units. So you really kind of want to look at the why. You really want to run the numbers and see, okay, if we get rid of this department, what's eliminated or what cost stays? And you want to look at, can you eliminate enough cost to make it worthwhile to do so? So in this case, with segment elimination, you would look at here, like with this one right here. Let's look at this situation. Let's look at this problem right here. A segment shows the following information: sales of 60, variable cost of 20. So that would give us a contribution margin of 40,000, fixed cost of 46. So that would give us a net loss of $6,000. Now, if we decide to do away with this segment, all variable costs are avoidable, and 36,000 of fixed costs are avoidable. And the typical example you're going to see is that a company can usually not eliminate all the fixed cost, because, like I said, a lot of the fixed costs are allocated costs from headquarters. They could be things like long-term rental agreements that the company can't get out of. They're going to have to still keep paying rent even if they do away with that store or that location. So what is the change in income from closing, and should the company close this segment? So we would do a financial analysis, and we would do, okay, what's going to be the effect to the company's overall financial status if they continue? And it's the same numbers really as we looked at before, basically a loss of 6,000. But notice that if they eliminate it, they only eliminate 36,000 of the fixed cost. And so basically there would still be $10,000 of fixed cost out there. So they would have an overall loss of 10. So in this case, they are better off to keep it open, because basically they cannot eliminate, they basically will have a greater loss than if they continue it, because they can't eliminate all the fixed cost. And kind of another way to think of this problem, another way to to kind of think about this is the company cannot eliminate enough fixed costs to overcome the lost contribution margin. So in this case, they could only eliminate, notice here, 36,000 of fixed cost, but the contribution margin was 40. So if you can't eliminate enough fixed cost to overcome the lost contribution margin, you're just going to be worse off. Like in this case, the company would have $4,000 overall of additional losses if they close this segment because they cannot eliminate all the fixed cost. Okay, now let's look at another example. A company reports this of one of its divisions. Sales of 980, variable cost of 700,000, so a contribution margin of 280,000, and fixed costs of 340,000 for a net loss of 60,000. All the variable cost and 300,000 of the fixed cost are avoidable. So they would eliminate all the variable costs, and 300,000 of the 340 of fixed cost would be eliminated if they decide to close this segment. So let's analyze this and to see should they drop it. So basically, if they continue, same information is up above, they're going to have a net loss of 60,000. But notice that that 300,000 of the fixed costs can be eliminated. So of the 340, 300,000 can be eliminated. So there's still going to be $40,000 of fixed cost there. So that's going to basically be $40,000, and their net loss would be 40,000. So in this case right here, they should close the division because overall they would be better off, or they would be $20,000 better off, the difference in the loss of the segment and the loss without the segment. And one of the keys here is notice that they were able to eliminate 300,000 of fixed cost where the contribution margin was only 280. So in this case, since they were able to eliminate more fixed cost than the lost contribution margin of that division, they should close the division. Now, a qualitative aspect that you would look at when it comes to these decisions, though, is if you're closing a division, how will it affect the employees? Will it cause layoffs? Once a company starts having layoffs, a lot of their better employees will wonder, okay, are we going to go next? What's going to happen next? Some of them will get other jobs. There's going to be some ripple effects whenever you start laying off employees. So if you can do something else with these employees, I think it kind of takes away some of those negative effects. You can move them to different places. Another kind of qualitative aspect or non-numbers, like a non-numbers aspect of it is, does this store affect other areas of your business? Such as if it's an outlying store, does having that store increase your online sales in that area? And if you close that store, would your online sales suffer or go down? Or what if Walmart decided to close sporting goods? Now you have to walk to the very back to get to sporting goods. So if Walmart decided to close sporting goods because they're not making much money, would they lose other business because of the customers that had to walk all the way to the back, saw other things they wanted and bought them while they were looking for golf balls or tennis racket or tennis balls or something back in sporting goods? So these are just some of the other things, or qualitative or non-numbers aspects that companies have to consider when they think about closing a segment or a part of their business. Now, the last thing we're going to look at is special offers. Sometimes it's called special orders, special offers. I'm going to put a little here of this because sometimes you'll see it as special orders. And what happens in a special order is this is whenever a company comes to you, and maybe you've never done business with them before, or you don't often do business with them, and they come to you and say, hey, our regular supplier can't give us what we need. We've got too much demand right now for what we've got for our product. And so they come to you and say, can you make 10,000 units for us at this price by this time? And they basically just lay the offer out there. And so kind of the decision-making focus here is, does the special offer increase profitability of the company? And when you're looking at this, here's kind of the key. You want to look at the revenues and cost only specifically related to the special order. And the reason that you want to look at it only specifically related to special order is because the fixed cost now typically this is the variable cost, typically the cost or the variable cost, the cost of producing the product or service. Because think about it this way, most of your fixed costs, they will not be affected whether you accept or you decline the special order. The cost of the building is going to remain the same whether you accept the special order or not. The cost of your equipment is going to stay the same whether you accept the special order or not. So what you're looking at are what are the revenues versus the cost specifically related to the special order. And typically it's variable cost. Now, if you do have to buy some new piece of equipment or something for the special order, then of course that would also factor in. But most of the time your fixed cost are only your variable fixed cost, or most of them are not even counted in the calculation. So the first question you want to ask yourself here is, do you have the capacity to do it? And here's one thing, special orders usually are at a lower price point than what you charge your normal customers. And so you don't want to bump your regular customers, or you don't want to hurt those customer relationships if you don't have the capacity to complete the special order or special offer by the time that they need it. And so sometimes if you're full, you don't have any capacity left, you've just got to say, no, we just don't have capacity to do it for you right now. Because like I said, again, you don't want to anger your current customers. So first question, do you have capacity? Now, if you have capacity, then you run a financial analysis, again, that looks at the revenues versus the cost specifically related to the special order. And let's look at it. Let's kind of talk about this real quickly here. A company sells their product for $300 each. The company makes 3,750 units per year and can make up to 5,000 per year. So that's like their total capacity, 5,000. The product costs $225 per unit with $150 in variable cost and $75 in fixed cost. The company receives a special order of 750 units for $250 each. Now, notice they have capacity, that they make 3,750 now. They can make up to 5,000. So they do have the capacity to do the special order. So the special order, 750 units for $250 each. And the incremental cost, fixed costs are $60 per unit. What is the income for the special order, and should the company accept? And again, the company has the capacity to accept the special order. So we would kind of set up a table just like this. So on a per unit basis, they're going to pay $250 they're going to receive $250 per unit if they do the special order. The variable costs are going to remain the same. Typically at the special order, your variable costs remain the same, because think about it, variable costs are the cost to produce the product or the cost to produce the service. They remain pretty constant. Now, your contribution margin is going to be 100 per product, and the fixed costs, the incremental, are going to be 60 per unit, which gives you income of $40 per unit. Now, remember that fixed cost, again, the problem will tell you what fixed cost amount applies, because remember that typically it's only your variable fixed costs that are going to apply for this. So if we were to run the total numbers, the 250 times what the 750 units, 187.5. The 150 times 750 units, 112.5, gives us a contribution margin of 75, minus our fixed cost, which is 60 times 750, going to be 45,000. That would give us income of 30,000. So in this case, the company should accept the special order because it is bringing in income. It's going to help their bottom line to accept the special order, since they have capacity and they're going to make money off of it. This would be a good deal for the company to accept. Now, what are the qualitative aspects of a special order? There's really a couple that I can think of. One would be, what if this leads to future business? So what if you're a small company and maybe you make toys, and a company like Disney comes to you and wants a special order? You would think, wow, this is my chance to impress Disney and maybe to form a future business relationship that could make us a lot of money, that could really help grow our business. So sometimes you do it for the expectation of future business. And you might even just break even on it, but again, maybe it leads to future business. Now, another kind of downside to it from a qualitative standpoint might be that typically with special orders or special offers, the price that you receive per unit is less than what you charge your normal customers. That's pretty normal. And so some companies are reluctant to do special orders sometimes because they have some fear that their regular customers will find out that they've done business with this company and sold them some product at a lower price. Now, companies don't really share that information. And so it's doubtful, but some companies do fear that. And that's another kind of a qualitative or non-numbers aspect of the decision that a company would have to make. So let's look at one more aspect of it here. Let's look at one more example. A company produces 80,000 units per month. The costs are listed below and the normal selling price is 100 per unit. The company receives a request for a special order of 20,000 units at $75 each, and the company has the capacity to produce 120. So basically, they're producing 80, they can produce 120, the special order comes in for 20. So they have capacity to do it. So now they're going to do it. They want to do a financial analysis to see, is this worth it for us money-wise? Now, there are no additional fixed overhead or fixed general and administrative cost if the special order is accepted. So what that means is that only variable costs are really going to apply to this product, that there's not going to be any fixed overhead or fixed general administrative cost related to it. So kind of as we come down the list here, these are the normal cost of production. But notice it includes fixed overhead, fixed general administrative. This is them producing what 80,000 units. This is normally what their costs are. So we would come down here and we would say that, okay, if we do the special order, we're going to have direct materials cost. We're going to have direct labor cost. We're going to have variable overhead cost. And so our per unit is going to be $51.50 per unit. Notice no fixed overhead, no fixed general administrative cost. And so what we would do here is we would take the 20,000 times the direct materials cost to come up with our total cost of direct materials. And then we'd take the 20,000 times the direct labor and we'd get our total cost here, and take the 20,000, or excuse me, the 20,000 units times the variable overhead to get our total variable overhead cost. We add it all up and our total cost to do the special order would be $1,030,000. Now, our revenues from the special order are going to be 1.5 million. So in this case, we should accept the special order as it brings in additional income of $470,000. So again, you want to separate the cost and the revenue specifically related to the special order aside. And if the special order, if you've got capacity and the special order makes you money, then you should accept the special order. That's really the quantitative analysis of this decision. So thank you for looking at business decisions with me, and have a great day.